In the early 1950s, Warren Buffett described an $8 dividend as well protected. Then earnings collapsed, the dividend was cut in half, and the stock fell as low as $60. Buffett flew to Cleveland for answers and arrived after the shareholder meeting had already ended. Yet a 1952 midpoint buyer who held through liquidation could still earn roughly 21% a year. How can the thesis be wrong and the investment still work? Buffett owned the stock personally, wrote a brief report on it, and recommended it to brokerage clients. After the cut, he was frustrated enough to nickname the company Cleveland's worst mill. The same cheap price contained two different bets, one on continuing earnings and another on what the assets could produce if the mill stopped. Cleveland worsted mills made woolen and worsted cloth, and at its peak ranked among the country's largest worsted producers. It spent about $2.7 million modernizing machinery from 1947 through 1950, leaving Buffett with well-equipped mills, not obsolete scrap. But the industry had been fighting excess capacity and declining demand for heavy wool clothing for decades. By the 1950s, synthetic fibers and lower-cost southern and foreign mills were making the economics worse. The machines were modern. The demand underneath them was not. During 1952, the shares traded between $84 and $100. Against that price, net current assets were $149.05 per share, while tangible book value was $184.69. At the midpoint, the stock sold for about 5.2 times earnings and less than 2 times enterprise value to operating profit. Its $8 dividend yielded about 8.7%, with a reported payout ratio below 50%. Buffett's memo, as quoted in the surviving account, called the dividend well protected. Cheap assets, cheap earnings, and a large payout all appeared to point in the same direction. The dividend looked protected because Cleveland Worsted had not earned less than $8 a share since 1945. But those past profits had been lifted by shortages and unusually strong wartime demand for worsted cloth. As conditions normalized, earnings fell 71.7% to $5.05 in 1952, forcing the company to use cash to maintain the payout. Earnings reached only $5.91 in 1953, then collapsed to 45 cents in 1954. Management cut the dividend in half. The balance sheet had delayed the bad news. It had not made the income durable. Buffett had bought the shares himself and put brokerage clients into them, so the cut was personal. He flew to Cleveland for the annual meeting, arrived about 5 minutes late, and found it already adjourned. The chairman's answer was simply, "Sorry, too late." A sales agent who sat on the board took pity on Buffett and answered some questions privately. By 1954, the stock had traded as low as $60. But the surviving account does not establish whether Buffett sold then. In August 1955, Cleveland worsted workers struck for higher pay and a union contract. President Louis Posse believed weak earnings were the start of a lasting decline, with synthetics and lower-cost competitors eroding the business. On December 31st, he announced an intention to liquidate, and shareholders approved the plan the following month. Posse owned about 22% of the company, aligning a large part of his wealth with the other shareholders. The company sold its buildings and machinery, sending newer equipment to West Germany and older machines to Mexico and Argentina. Greif had escaped decline by changing the business. Cleveland Worsted escaped by ending it. In 1957, Cleveland Worsted distributed $185 per share. Later payments of $10, $3.63 brought the liquidating distributions to $198.63. A shareholder buying at the midpoint of the 1952 range would have earned a 21% internal rate of return through the liquidation. Someone buying after the 1954 dividend cut could have earned roughly 50% a year. We do not know whether Buffett stayed, but the assets he identified were ultimately worth far more than the market price. Buffett's earnings judgment was wrong. The dividend was not protected by sustainable profit. His asset judgment was right. The liquidation converted undervalued machinery, property, and working capital into cash for shareholders. The difference was the catalyst. Decades later, Buffett warned that unless you are a liquidator, Buying mediocre businesses only because they look cheap is foolish. A low-return business can consume the bargain while an investor waits. Cleveland Worsted avoided that trap because management stopped waiting. In a deteriorating business, the exit is not an afterthought, it is part of the thesis. Grafe survived by changing, and Cleveland Worsted paid by closing. Next, Buffett finds a bus company selling for less than the cash on its balance sheet and discovers what an investor can change from the outside.